MD Investor, the channel where we're talking about personal finance, setting goals, achieving goals, teaching ourselves and our children so we can break the cycle of generational poverty. Today is going to be a new video about another financial metric called the dividend payout ratio, or simply the payout ratio. We've mentioned that during our previous videos. But before we get into it, let's mention that on YouTube it's the MD Investor. On Instagram it's MD Investor1. Let your friends and family know this content is something that can benefit them. And without further ado, let's get into it. So the dividend payout ratio. What is it? The dividend payout ratio is simply the dividends divided by the earnings per share. Or companies are in business to make money. Bottom line. Obviously, they do other things. They create good for society. For example, now in this pandemic we're in, we have all these pharmaceutical companies, Johnson & Johnson, Merck, Pfizer, all these companies, and they're trying to get vaccine for the virus. So that's doing good for humanity. But the bottom line is they're in business to make money. You take all the money they make, right? After you subtract the expenses, right? So you have your income or your revenue, you take away the expenses, and the net amount left over is earnings. And you take the earnings, you divide it by the total number of shares outstanding, and you get the earnings per share, which means how much money is the company earning per share. They call it EPS. You take the dividends, and the portion of the dividends out of the earnings is your payout ratio. Quick example. So say a company is making $2 earnings per share, right? For every share they have outstanding, the company earns $2. Out of that $2, if the company pays $1 in dividends to the shareholder, the $1 divided by $2 is half, or 50%. So you would say this company has a dividend payout ratio, or simply a payout ratio of 50%. Simple. So the company makes $2, it gives $1 back to the shareholders in a form of a dividend. So you may ask the question, what does the company do with the rest of the earnings, right? Because they earn $2 per share, they give $1 back to their shareholders, but there's $1 left over. What does the company do with that? Well, the company do use that to grow the company, right? Some of you hear businesses having mergers or acquisitions. They may buy a smaller company that may be a competitor, and the company may have something that the other company may need to make them grow, so they'll use that money to buy. They may use that money also to pay debt. They may use that money to get involved in research and development, especially like in a pharmaceutical company. They may use it for cost of raw materials, company in the manufacturing space, different expenses such as employee salary. So the earnings is basically what's left over after expenses, and it's the net profit. You can think of it, right? So the company has their income or their revenue. You subtract the expenses, and then the net amount left over is the earnings. Out of the earnings is where the company pays the dividend. And the portion of the dividend out of the earnings is called the payout ratio. Okay? So again, let's get back to our example, right? Our payout ratio is our dividend over the earnings per share. The example we use is the earnings is $2 and $1 is dividend. So the payout ratio is 50%. So since it's a ratio, right, which is the dividend over the earnings per share, there's a numerator and there is a denominator. So the question is posed, What happened to the payout ratio if the earnings per share decrease? So here is the payout ratio, right? Dividends, which is a dollar over earnings per share. And in our example, the payout ratio is 50%. What happens to the payout ratio if the earnings per share decreases? So imagine if a company going through problems, right? And we don't have to think too far back. We can think now during the pandemic of Carnival Cruise Line. We can think of Boeing and all of the hotel or travel stocks. What do you think is happening to their earnings per share? You think they're making money during this time? No, their EPS or earnings per share is decreasing, right? So, if we're in this example, so instead of like say $2, say their earnings per share drops to $1. So now the payout ratio would be $1 over $1, which would be 100%. So the answer to the question is, what happens to the payout ratio if the EPS or earnings per share decreases? The payout ratio increases, right? Which answers our next question. Can the payout ratio be 100% or more? Yes, it can be, right? If instead of earning $2 because of say problems in the business or such as the pandemic, right? Look at a company like Carnival Cruise Line or any of the travel companies. Their earnings per share would be decreasing, and if it equals exactly the dividend, right? Whatever comes in, you're paying out in dividend. Your payout ratio is going to be 100%, which is not good because there's nothing left over for debt, for merger, for acquisition, for research and development, for in case the cost of raw materials go up or cost of employee salaries. There's nothing left over. There's no margin. That's the equivalent of an individual living, say paycheck to paycheck, meaning everything comes in, they're spending 100% of what they make. That'd be the equivalent. So can the payout ratio be 100% or more? Absolutely. Now, let's say the dividends is $1, and the earnings drop from $2 to 50 cents. Now, $1 divided by 50 cents would be, it's going to be 200%. So yes, the payout ratio can be 100% or greater. Now, you may think, how can a payout ratio be greater than 100%? We are making 50 cents, but we're paying out $1 in dividends. How can it be? It's the same way that a person can earn $50,000 a year, but they spend $60,000 a year. How can that be? There's people who do that. Debt, such as credit card. Companies can also overly rely on debt, and for a short time for a short while, they can pay out greater than 100%. They can pay out more than they're making. Obviously, that's not sustainable, and that's one of the reasons we look at the payout ratio, right? Because when it becomes too high, we begin to wonder why is it so high, okay, and is it sustainable? Okay, what is a good payout ratio? We'll say a good payout ratio is, we'll say in the 50% to 55, 60% is a good payout ratio. You feel that the company is keeping back enough of the earnings so it can survive, it can manage, it can pay debt, it can do research and development, it can grow, all those things. So good payout ratio, we say 50 to 60% is a good payout ratio. When it gets to be a little higher, 70, 80, 90, obviously you begin to worry, is this sustainable? Let me add that there are some sectors that have a higher payout ratio than others. And what I'm thinking of is utilities. The utility sector, companies such as Con Edison, um, Southern Company, Duke, Dominion Energy, they have a higher payout ratio because they're capital intensive, right? They need a lot of capital expenditure to run their business, right? All the generators and raw materials and so on. So having a 80, 85% payout ratio in a utility company is not unusual, okay? So the big question, obviously, from all this information from this video is going to be, can the company continue to pay the dividends? That's all you want to know, right? Because as a dividend investor, you want to know that when I begin to rely on this dividend income to live, is it reliable? Do I have to worry, is the check going to be there this quarter and next quarter it's not going to be there? They're going to be there this year and next year I really can't really trust it. Can the company continue to pay the dividend? That's the question. And the payout ratio helps us, right? A company that's paid with a payout ratio of say 20%, meaning they are paying 20% of their earnings back to the shareholders in dividends. That means they're keeping 80% back to research and develop and grow the company. Is a lot different than a company that's paying 90% of their earnings in dividends. The 20%, there's so much room for the company to grow in case there's any mishap or any change in the economy. There's room for them to increase the dividend. There's room for them to grow the company. 90%, there's not much leeway, okay? If the cost of goods and raw materials go up, the employee expenses go up, there's not much room or margin in which they can grow the dividend, okay? So that's a big question. Knowing the payout ratio helps us to answer. So we say most of the companies that we look at, it's called a dividend growth investing, or DGI, dividend growth investing. So when a company is paying a dividend, we don't want a dividend to be stagnant, right? Because if the company is paying $1 per quarter in 2020, you would expect in 2021, 2022 them to grow the dividend. Why is that important? Because of something called inflation. Because even though it's paying $1 now, if you pay the dollar again next year and $1 the next year, even though it's still $1, the buying power will be less. So if they're paying $1 now and in 10 years they're paying $1, you are not going to be able to buy the same amount of goods and services as you did 10 years prior. So you want the dividend to continually increase. That's why whenever I show the charts from like Seeking Alpha, I always like to see the stair step dividend increasing year over year over year. So if the payout ratio is the ratio of the dividend over the earnings per share, if the dividends continually going up, the numerator, right, which is what we want to see. We want to see the dividends continually going up. If the dividends continually is going up, you will have to have the earnings also going up to maintain the payout ratio, right? If we go back to our example, if the earnings per share is $2 and the dividend is $1, right? If the earnings stay the same and the dividend is going up from $1, so $1 over $2, the payout ratio is 50%. If the dividends go up from like $1 to $1.50 over $2, now the earnings per share is probably going to be about 75%. If the dividends go up to $2 and the earnings remain the same, it's going to be $2 over $2. The payout ratio is not going to be 100%, which is not good. If it keeps going up and the earnings stay the same, that's not sustainable. Because eventually you're going to get to a point where you're paying out more in dividends than a company's earning in earnings. Not sustainable. So if you want to maintain the same payout ratio, if the dividend is say $1 and the earnings is $2, if you want to maintain a 50% payout ratio, if the dividends go up to $1.50, then the earnings is going to go up to $3 to maintain that 50%. Okay, so that's why companies are so meticulous in their numbers. Right? Whenever you watch their earnings report, or listen to the conference call, they're always talking about month over month or quarter over quarter increase or year over year. They track the numbers because the numbers and those metrics are very important because that let them know how their business is performing. Okay, and we have to be the same way in our personal finance. So if we're increasing our dividends, we have to increase the earnings per share, and that's why they're very keen on those metrics: earnings per share. How does it compare to next year? How does it compare quarter to quarter? Why, if it dropped, why did it drop? Was it because of weather? Was it because of the coronavirus? Whatever it is. So let's look at a couple of examples, and then we will call it a day. So we're going to look at a couple of examples of different payout ratio. Okay, let's look at Apple. So we look at some low payout ratio, some moderate, and then some high. So Apple has a quarterly dividend of 20 and a half cents, right? About 20 and a half cents. Pay the quarterly. For the annual payout is 82 cents in dividends. Payout ratio is 20.82%. So Apple has a very low payout ratio. So what does that tell you? That tells you out of all of their earnings, they're only paying out 21% in dividends. That means they're keeping back about 80% of the dividends. I mean, correct me, 80% of the earnings to do research and development, to pay down their debt, to grow the company. So that's very comforting. And you can see the growth rate, 5-year growth rate is over 10%, right? Because they can grow that dividend because they have so much cushion, okay? That's something you feel comfortable with. Even though the payout yield, the dividend yield is very low, only less than 1%, they are able to raise that dividend because the payout ratio is so low. So let's look at the earnings. So they're paying out 20 cents in dividends, right, per quarter. The earnings, the actual earnings is about 73%. And the estimated upcoming earnings is almost $1.40. And they're only going to pay out 20%. So you see the cushion they have, right? Let's look at another company that also has a pretty low payout ratio, Microsoft. Microsoft is paying about 56 cents quarterly, so $2.24 for the year. The payout ratio is 33.23%, about a third. So Microsoft pays out about a third of its earnings in dividends. The other 2/3 they're keeping back to grow the company. So let's look at the earnings. So remember, 56 cents is being paid out every quarter for dividend. The last earnings, when they announced October 27th, the actual earnings was about $1.82, and they only paid out 56 cents, right? So the rest of that, like maybe $1.30, right? They are keeping back about 2/3 of the earnings to grow the company, okay? So because of that, again, they have a nice 5-year growth rate. The initial the dividend yield is low, but they're able to grow the dividends. Okay, let's look at something in the middle. Okay, let's look at something in the middle. Let's look at Johnson and Johnson. So Johnson and Johnson pays $1.01, and he pays it quarterly. So $4.04 for the year. Payout rate is about 50%. So I mean, Johnson Johnson pays about half of its earnings out as dividends. The other half it keeps back, so it can grow the company, do research and development. Again, during this pandemic, they're doing research and development involving getting getting a vaccine, right? So $1.01 they're paying per quarter. Let's look at the earnings. So the last actual earning per share was $2.20, and with it they're paying about $1. So you see how comforting that makes you feel, because if the payout ratio is so low, they're able to grow that dividend, right? 5%, correction, 6%, 6.3%, 5-year growth rate. They're able to grow that dividend. Let's look at a company that has a higher payout ratio, one of the utilities, right? So let's look at maybe Southern Company, ticker symbol SO. So this is one of the utilities. And remember I said that utilities or in the sector that they're known to have a higher payout ratio. So the Southern Company pays 64 cents per quarter. For the year, it's paying about $2.56. Now look at the payout ratio, 80%. So 80% of the earnings is being given back to the shareholders in the form of dividends. So they're only keeping about 20% back to grow the company, research and development, and so on. But we said that is not unusual. That is standard or normal for the utility sector, right? So 64 cents is the dividend per quarter. Let's look at the earnings. So it's making about $1.22. It's giving about 62 cents. Okay. Let us look at a REIT, Iron Mountain. That'll be a good illustration. Iron Mountain. So Iron Mountain is a REIT, and it pays 61 cents, almost 62 cents a quarter, paid quarterly. So the annual payout is $2.47. And look at the payout ratio, 110%. How can your payout ratio be higher than 100? This means that this company is paying out more in dividends than they're earning. Let's look at earnings. Remember that because it's a REIT, they don't use EPS. They don't use earnings per share. They use something called funds from operation, FFO. So they're paying out, we said, about 61 cents, almost 62 cents, 0.6185, all right, per quarter. The funds from operation, which is equivalent to like the earnings per share, for November 5th, I guess the last quarterly earnings, was about 61 cents. So it's almost paying out almost everything. And in the estimated future ones coming up, it's going to be about 51 cents. So obviously that's something to consider, right? That the dividend they're paying out is actually more than they're earning. Okay? Obviously that is something that is not sustainable. Okay? Let's look at one more REIT, and then we will call it a day. Everybody's favorite monthly dividend payer, Realty Income, ticker symbol O. Let's look at that. So Realty Income pays about 23 cents, paid it monthly. It's a monthly pay. And you times it by 12, you get about $2.81 annually. And so the payout ratio is about 84%. Okay, so let's look at the earnings. So it says here funds from operation, which is almost equivalent to the earnings per share for the last quarter, was about 82 cents. Now, I think it's for the quarter, so that's 3 months, all right? We'd have to divide this by 3 to see what is the funds from operation for the month. So 82 cents divided by 3 would be about to maybe 26, 27 cents, which makes sense because they paid about 23 cents. So 26, 27 cents. So you'll see it is paying out a large portion, but it's not over 100%. So that is realty income. So guys, we'll call it a day. We'll stop right here. So the payout ratio is another metric that we are learning about. We have to be aware of it because obviously it tells us how much of the earnings of the company paying out, and that will help us to know that it is dividend sustainable. As dividend investors, we want to make sure the dividends are sustainable and they're able to grow over time. And the payout ratio is another metric to look at. So again, that's another video to kind of increase our financial IQ so we could break the cycle of generational poverty and be smarter investors. If there's friends, family out there you think could benefit from this information, let them know about the MD Investor. And don't forget to subscribe on YouTube. Even if you watch it on Facebook, definitely subscribe on YouTube. And on Instagram, it is MD Investor 1. And don't forget to command your money to grow. And I will see you on the next one.